How is everyone doing? You are in the strategy room on this Saturday night, November 22nd. 2025. You are here with your host, Dr. Joe Berquist. So I got a great show lined up for everybody tonight. Very excited to be back in the saddle once again here with everyone on a great Saturday night. So got a lot to get to tonight. We're going to be talking about what's going on with the Fed's decision. We got a obviously tariff news update. I've got some crypto updates for everybody. What's going on with the crypto market? Got a little bit of private credit update, not too much on that. I've got a lot of banking news I'm going to be coming with everybody. We're going to be talking a little bit about the middle class tonight. How is the middle class struggling? Going to be talking a little bit about the labor market. We did get some labor news that came in this week, which was very interesting on the jobs front. So a lot to get to, and we've got a lot to jump into. Let's jump right into it tonight here. So as I always like to do at the start of every show, we like to check in on the U.S. debt clock to see how we're doing. So still cruising in at a little over $38 trillion on the national debt. The U.S. federal budget deficit still hanging in at $1.7 trillion to the negative. Doge, where are we at with Doge? So the Doge clock goal is now up to $719 billion, but the actual Doge clock now is $214 billion. The debt to GDP is actually notched up a little bit. It's up to 121%. Anything else? Credit card debt still hovering at $1.3 trillion. Not too much else, but not too much, not too much different here between the last week or so. Now, I will say this, though. While you don't see a lot of change in this from a week-to-week basis, you do see a big change in this from a month-to-month basis. So the national debt is basically going up by $1 trillion now, roughly about every 90 days. About every 3 months, we are tacking on another $1 trillion. So we jumped from 35 trillion up to 38 trillion in basically just the last year. I mean, it's in the last 9-10 months. So, I mean, the national debt is just growing at an exponential rate. And on a side note, this is why when we talked about getting the $2,000 tariff checks last week, we talked about that a little bit. This is why, like, I don't really want that. I don't really think it's going to make that much of an impact for the consumer. We're already dealing with inflationary issues, at least what the Fed is overly concerned with. So why potentially add to that? Why not just take that? I mean, the whole point of bringing in those trade funds was to have extra money so you didn't have to raise taxes on people, and you could try to start to balance the budget, pay down the national debt a little bit. So that's where I'm at with that. I would really like to take that tariff money and really begin to plow it into, getting our federal budget deficit down, maybe try to get the national debt paid down just a little bit. Anything at this point, just to make a tiny dent, right? Okay, but that's where we're at there on the national debt front. Now let's jump in. I wanted to jump into this here real quick for a second. Going to make this a little bit smaller here so everybody can see good old Larry's picture. So last week I brought everybody an update on the Epstein story, because I came at it from the point of view of banks. How is this going to affect banks? Now, Larry Summers, arguably one of the most, some would say one of the most accomplished economists of the last 20, 25 years. Larry had to basically resign in disgrace this week from the board of OpenAI. At Harvard, he was basically begging the students for forgiveness. I don't think that's enough for good old Larry here. I don't think that's enough. I think Larry needs to come clean. I think Larry needs to tell us a whole lot of information about what did he know, when did he know it, who was involved, who did he see there. So yeah, Larry begging for forgiveness is not that we haven't gotten to that point yet. We haven't gotten to that point yet. We'll figure out where our forgiveness lies with Larry after he spills the bean. But let's put that aside for a second, because I wanted to focus on the point of this article. This is from the Wall Street Journal, and this was from today. This was called How Larry Summers' Power delayed the reckoning over his Epstein ties. The key word there being power. The former Treasury Secretary and Harvard president's enormous network and clout kept him immune from past Jeffrey Epstein revelations, but this time was just too much. Now, the reason why I wanted to point this out is because, not to go on some big soapbox or anything like that, just to point out to people that this is very true for all of the people involved in this. This isn't just unique to Larry, because this wasn't just Larry involved in this. This was hundreds of some of the most powerful people in the world involved in this. And they all used their power and their enormous connections to basically, and their clout to keep themselves immune from this. And I have a feeling that Larry is just going to be the first in a long line of people that we know. We already know who all these people are. We already know their names. I'm not going to repeat all their names. We already know all their names. I just thought it was fascinating that the Wall Street Journal, of all the media, would be writing this article here, basically saying how, Larry, we all knew that Larry was there. We all knew that Larry was involved. Like, here's the picture, all these pictures of Larry with Epstein. We've seen all these pictures. We've seen these pictures for years. Perhaps one of my bigger gripes, though, with Larry is that Larry was one of the primary architects of the 2008 financial crisis. And Larry, I don't think Larry has gotten torched enough for his responsibility and his role he played in bringing about the 2008 financial crisis. He skips out on Wall Street and he just runs right in, becomes the president of Harvard, and Harvard's all too happy to have him right over there. And it's just ridiculous. I'm not going to go through this whole article here because, like I said, I didn't want to get on this huge diatribe. I just wanted to show you that this is the first. I think this is the first of many scalps. Larry Summers is the first of many scalps to come here on this Epstein train that is going to come through here, and this is going to affect banks. As I pointed out last week, this is going to have an effect on banks, because some people in banking and some people at the biggest banks in the country were involved with this. And so, I think there is more to come. I think there's more to come, but we shall see. But let's roll through here, because I got a couple other things here. Another very interesting one this week. So we found out this week that the former Fed governor, Adriana Kugler, violated trading rules while at the central bank, as per an ethics report that came out this week. So former Federal Reserve Board Governor Adriana Kugler broke the central bank's rules regarding stock trading, according to a report released by the U.S. Government Ethics Office. The report comes 3 months after Kugler abruptly and mysteriously resigned from the Fed's Board of Governors. That allowed President Donald Trump to appoint Stephen Miran to replace her. Kugler's violations were related to purchases of stock in companies including Apple, Southwest Airlines, Caterpillar, and Cava Group. Now, again, I have talked about this report. I've talked about this before. This is nothing new. We have seen this before. Again, a whole bunch of the Fed governors, a bunch of the Fed presidents, all got caught a couple years ago with their hand in the cookie jar. We saw 2 Fed governors from Dallas and Boston basically had to resign in disgrace because they both got caught doing massive stock trade. Jeremy Powell himself got caught with his hand in the cookie jar. Now, he was able to kind of sidestep that one, but he still got caught. Now, the funny thing is, they obviously knew this when she resigned, but of course they allowed her to resign, and then they try a couple months later to just quietly release this report when everybody's sitting there going, "Oh, why did she resign suddenly out of the blue?" And you kind of knew at the moment that there had to be more to this, and of course there was, and now we find out. Here it is. So she basically got caught with her hand in the cookie jar, being a pig at the trough, if you will, doing a bunch of trades. And this is the problem. We have to root this out. This is not just a problem at the Fed. This is obviously the Congress. The insider trading at the Congress is just, beyond. It is so far beyond the scope of anything ethical. It's just to be laughable at this point. Every single one of these Congress people, congressman, congresswoman, every single one of them go into Congress, and they don't have a pot to pee in or a window to throw it out of, and then they're in there for just 5, 6, 8 years, 10 years, and they come out and they're worth 20, 30, 40, 50 million dollars. Might have been, few of you might have heard in the news yesterday, it might have been a certain congresswoman who announced that she was going to resign from Congress next year. Now, she just happened to have an increase in her net worth of 700,000 to 20 million bucks. It's amazing. She was only there for like 4 or 5 years. $20 million. Pretty good. Pretty good on a congressman's salary, right? So this is a problem that needs to be rooted out of our government from top to bottom. And again, and you could tell, I would be willing to say that behind closed doors, what you are seeing is you're seeing a whole bunch of people at the Fed. It's like an entitlement thing. A whole bunch of people at the Fed, they're looking at all their people across the street in Congress getting stupid rich, and they're all sitting there going, well, hey man, why we should be able to do the same thing, right? We should be able to get away with this. And but they, obviously with the Fed, it's a little bit different than with Congress. Congress, they pass laws so they can get away with bloody murder. But nobody else is really quite allowed to get away with it the way that Congress does. So, but this is a major issue. I think this needs to become a major issue. We need to force Congress to stop this. We have to force Congress to stop this. We need term limits. We need to stop the insider trading. We need to make Congress yield. And we need Congress to live just as everybody else lives in this country. If anybody else did this stuff, we would be going to jail for insider trading. And that's what pisses me off. Adriana Kugler, she's allowed to just, resign and walk away. Okay. But if you or I did what she did, we'd be going to jail. So just so everybody's clear about that. So again, I saw this and it just got me hot. It just got me hot. All right, let's go on here. Okay, another thing here that's got me hot. I got a lot of stuff here tonight that's got me hot. Okay, Trump calls for preventing states from creating their own AI regulations. Multiple states, both red and blue, have moved to establish regulations on AI companies so far this year. Now, here is my issue with this. I don't like this. I feel like these AI companies are completely out of control. I feel like they're just doing whatever they want to do. We are starting to see now a bunch of things are starting to bubble up. There's a number of cases that have come to light about the number of people with using AI to commit suicides, a number of kids being misled by AI. There is a lot of dark stuff going on just underneath the surface. And I think we need a lot more rules, regulation. We need some kind of a rails. We need rails. I think that's a good way to put it, around AI and how AI is being managed, how it's being developed, this kind of Wild West, and this whole, oh, well, we gotta beat China to it, whatever. Like, no, actually, no, we don't. Okay, what we need to do is we need to choke China off. We need to basically stop allowing them to have anything. Okay, and that's not going to stop them forever, but it will eventually give us the opportunity to develop this the right way at our own pace, because they will forever be 6 to 12 months to 2 years behind us. Okay, if we don't let them get the best chips, if we don't let them get the manufacturing equipment to manufacture the best chips, okay, if we just simply we don't have to stop them, we just have to slow them down. Okay, and if we do that, we will always be able to stay out in front of them, meaning we can put the necessary rails and the regulation in place. Okay, I don't like this free pass basically from the Trump administration. I don't know what the tech bros sold the Trump administration on over there, basically saying that, like, oh, we have to win this AI arms race, otherwise, it's all over. I don't understand this. This is not like anything. This technology is not like anything else that we have had in years past. We cannot compare this to anything else. And this, in certain respects, this can be very, very dangerous, very dangerous. And I have said before that, Silicon Valley has their whole motto: move fast and break things, and that's what they live by. That's what they live by. And I have seen enough interviews now with with the whole crew, man. Sam Altman, with Zuckerberg, with just all these guys. And I've seen enough interviews over the last year to know that they don't care if they smash half the economy, if a whole bunch of people get if a million people get killed by because AI went rogue and did some crazy stuff. They don't care. They don't care as long as they are first to the party, and as long as they ensure that they're making themselves disgustingly rich. That's all they care about. That's all they care about at the end of the day. And again, and I'm not saying that I want to stop them from making money, or I want to stop them from being successful. I'm not saying any of that. What I'm saying is we have to have some kind of structure around this. And if the federal government is not going to do that, I'm not going to stop states from doing it. If states out there want to step up and they feel like they need to pass some AI regulation because they need to protect children in their state, or they need to protect the elderly in their state, or they need to try to prevent certain types of AI fraud in their state. Okay, hey, I'm not going to. I don't want to stop them from doing that. I do not want to, especially if the federal government is not going to basically is just not going to step up and do anything about it, just let the tech bros have a free pass on this one. So again, not very happy with this. I don't like it. And I do not think that the federal government should be preventing states from creating their own AI regulation. As a matter of fact, the states wouldn't need to do that if the federal government stepped up and basically said, hey, listen, we're going to allow these guys to do their AI, but we're going to put rails. We're going to put rails on this thing. Okay. This is not going to be the Wild West. We are not going to just let these guys run around. Their whole creed of move fast and break things, that's not going to work for us. Sorry, that's not going to work for us on this one. Okay. This needs to be done very diligently, very smartly. It needs to be done with a whole lot of care. And I need to say it needs to be done with some morals and some ethics. Okay, something that the tech bros in Silicon Valley are completely devoid of. Completely devoid of. But anyway, all right. All right, let's get off of that for a minute. Okay. Couple other things here real quick before I get into, because I want to jump into the crypto market and just talk real quick about what's going on with the crypto market. So Trump says that Jeremy Powell's Fed successor may already be picked. I'd love to get the guy currently in there out right now, but people are holding me back, President Trump told reporters. So President Donald Trump said on November 18th that he may have already selected his pick to replace Federal Reserve Chair Jeremy Powell. I think I already know my choice, Trump told reporters during a bilateral meeting in the Oval Office Tuesday with Saudi Arabia's Crown Prince and Prime Minister Mohammed bin Salman Al Saud. We have some surprising names, and we have some standard names that everybody's talking about, and we may go the standard way. It's nice to every once in a while go politically correct. Treasury Secretary Scott Bessent has previously stated that the administration had narrowed its search to 5 candidates to replace Powell when his term at the U.S. Central Bank ends in May. The final 5 included National Economic Council Director Kevin Hassett, BlackRock executive Rick Rieder, former Fed Governor Kevin Warsh, and Fed board members Michelle Mickey Bowman and Christopher Waller. Predictive markets indicated on November 18th that Hassett is the odds-on favorite with a 49% chance of becoming the next head of the Federal Reserve. This is followed by Waller at 21%, Rieder 12%, Warsh at 11%, and Bowman at 2%. Trump reiterated that he would have preferred Bessent to helm the Fed, but the senior administration official noted he preferred working at the Treasury Department. Trump also took shots at Powell again, blasting him for not lowering interest rates sooner. I'd love to get the guy currently in there out right now, but people are holding me back. The president said he's done a terrible job. Yeah, I don't disagree with that. The administration has repeatedly criticized Powell and his colleagues for not cutting interest rates earlier this year, while House officials and Stephen Mirren, a member of the Federal Reserve Board of Governors, have also suggested that the institutions need to lower rates much more quickly than monetary policymakers have been doing over the past couple of weeks. Just wanted to point that out. So we might already have the pick. Now, I will say this, and I've said this before. I really don't want somebody in here who is politically correct. I'm again. I think the names of the people that they have come up with are okay. That's what I was trying to look for. Oh, here we go. Okay. Um, I would say the odds-on favorite right now, Kevin Hassett. I'd say that yeah, he is probably the guy. He's probably going to be the guy. Um, Kevin really doesn't do a whole lot for me. He really doesn't do a lot of it. I have said I think you need a fire breather. I think you need somebody to go in there and really kick some people in the butt, break up the group think at the Fed, and really get really kick all those PhDs over there, really kick them in the butt and really press them. Really say, guys, how have you gotten it so wrong over the last 15 years? How have you gotten it so wrong? And again, I don't think that Kevin Hassett seems like a great guy. Do I view Kevin Hassett as kind of a butt kicker who's going to go in there like a man on fire and just maybe fire a few people and really get things going again? No, I really don't see Kevin Hassett as that type of person. So again, again I've said this the last few weeks. I'll say it again. This pick is so critical. It's so critical because as we've seen with Jeremy Powell, once the pick is made, that's it. You're not getting them out. If the person turns into a huge disappointment, you're not going to get them out of there. They're just not. You're going to be stuck with them for a long time. That person's going to be there longer than Trump is going to be in office. So it is absolutely 110% imperative that Trump make the right pick here with the next Fed governor. It's absolutely imperative. I mean, it literally could make the difference ultimately in his presidency, depending on who he picks for this job. So, okay, now here was very interesting. So Donald Trump, he was speaking at this forum in Washington, I think on Wednesday. And this was an article here in Investopedia, basically Trump to Treasury chief, fix Fed rates or you're fired. Now, the headline obviously catches your eye right away. I think this was a little bit of an exaggeration, but let's take a look. So President Donald Trump once again expressed his desire to fire the Fed chair, Jeremy Powell, who has kept interest rates higher than Fed would prefer. Trump also threatened to fire Treasury Secretary Scott Bessent if he could not get Powell to cut rates. The Fed is an independent central bank, and Powell does not report to either Trump or Bessent. In pressuring the Federal Reserve to lower its benchmark interest rates, President Donald Trump is putting a twist on his "you're fired" catchphrase from his days as I like this, as a game show host. No, he was not a game show host. He was a reality TV show host. Minor technicality there, minor technicality. Speaking at a Saudi Arabian investment forum in Washington, D.C. on Wednesday, Trump not only renewed his frequently repeated threats to fire Fed Chair Jeremy Powell, but added his own Treasury Secretary Scott Bessent to the firing line if the Fed does not move faster to lower borrowing costs. It was unclear how serious Trump was with either threat. The only thing Scott's blowing it on is the Fed because the rates are too high. Scott, if you don't get it fixed fast, I'm going to fire your bleep, he said, provoking laughter in the audience. Yes, I'm pretty sure he was joking. I don't really think he was serious. Scott is one of the people in his administration that has absolutely done a fantastic job this year, bar none. His job of just managing the treasury auctions, managing the bond market and the treasury market, just making sure that everything went good there. The absolute mess that Janet Yellen left him on his first day there. Just the fact that he has been able to completely turn this thing around and really manage this thing. Scott Bessent has done an absolutely amazing job this year for President Trump running the Treasury. So, and it goes on, Trump has repeatedly criticized Powell and all that. Yeah, we got all that. But we'll see. But again, we'll have to see there. But again, it was just interesting. I just wanted to put it out that, Trump is putting pressure on the Fed, but at the same time, I really don't think we're going to get a rate cut here. I really don't think the Fed is going to cut rates in December. Jeremy Powell said it at the last meeting that he's not going to do it, and regardless of the economic data, whatever. But anyway, to continue on to the point of how good a job Besson has been doing, let's look at this article here from the Wall Street Journal. Bonds are headed for the best year since 2020. So the Federal Reserve cut rates, overwhelm deficit bears, boosting treasuries and the corporate debt. So you can see here T-bills and Bloomberg aggregate, basically, but going up, doing very well here in 2025. Saying best year since 2020. So again, just showing you what a great job. So almost everything has lined up for bonds lately. The Federal Reserve has been cutting interest rates, jobs growth and consumer spending are slowing, keeping hopes for further cuts alive, but not pointing to an imminent recession that would threaten corporate balance sheets. Inflation pressure has continued to moderate despite fears that President Donald Trump's tariffs will drive prices higher. Again, I love how they all, it's almost exhausting at this point that they all forever putting this line in here about tariffs. It literally is their boogeyman, their catch-all boogeyman for everything. Tariffs have done nothing. And what's even more comical that I reported last week is that the Federal Reserve just put out a research report. They went back, the San Francisco Federal Reserve Bank went back and looked at 150 years of tariff data here in the United States. And you know what their conclusion was? Oh, tariffs are deflationary. Deflationary, meaning that, yeah, you're not going to get inflation from tariffs, okay? What I've been telling everybody for over a year now, you're not getting inflation from tariffs. And tariffs are not inflationary. They may cause people to increase some prices, but a price increase because you're dealing with expenses is not the same thing as inflation. And I've said this 100 times, and I keep saying it. Inflation comes from one thing and one thing only: government spending. That's where the inflation comes from, the government spending. Okay, you cut the spending, we've reduced the spending, and the inflation, like magic, has come way down. Okay, but you've got to finish the job. If you want to get the inflation back down below 2%, you've got to wait for it. You got to balance the budget. You got to start paying down the national debt. If you can do that, all the inflation magically will go away. But anyway, the widely tracked Bloomberg U.S. Aggregate Bond Index has returned around 6.7% in 2025, accounting for price changes and interest payments. That puts it on pace for the best year since 2020. Bonds had regained ground after the Fed's inflation fighting campaign fueled a historically bad 2022. The Bloomberg aggregate made up largely of treasuries. Investment-grade corporate bonds and agency mortgage-backed securities returned 5.5% in 2023, though it almost stalled in 2024. That was on purpose because of Grandma Janet. Investors said 2025 feels different. Yeah, no, you know what? The climb has rewarded investors, still stinging from the unusual volatility that followed the COVID-19 era inflation surge. Unlike in the previous few years, the index's returns have easily outpaced those of short-term T-bills, the other main choice for investors seeking a safe alternative to stocks. It's certainly been more fun to go to client meetings this year as a bond manager, says Cal Spranger, a fixed income manager at Badley Phelps Wealth Managers. A few years ago, I wasn't getting invited to any. While yields on government and corporate bonds have gradually come down, they are still far above the paltry levels seen during much of the past decade, and investors want to lock them in while they can. And then here it goes with a little chart here on the 10-year U.S. Treasury note. We'll get to that, get back to that in just a second. At times earlier this year, brief but sharp sell-offs in U.S. Treasury sparked alarm that the bond market might finally be buckling under the pressure of outsized U.S. borrowings. The size of the budget deficit can influence yields because a larger deficit means the government needs to borrow more by issuing treasuries and in turn attract demand for that debt with higher rates. Falling rates have largely overwhelmed all of those concerns because bonds issued when rates are high become more valuable when they are expected to decrease. At the start of the year, investors were unsure if the Fed would be able to cut rates given persistent inflation and expectations Trump would pursue expansive fiscal policies. But a cooling labor market has already resulted in 2 cuts this year, with another reduction still possible. Treasury yields, which fall when bond prices rise, have decreased as a result. The yield on the 10-year note has slid by nearly a half percentage point this year, settling Friday at 4.147%. Also aiding bonds, the Trump administration has kept close tabs on the market, at times swooping in during turbulent periods. The president paused the bulk of his so-called reciprocal tariffs in April because of yippie bond investors. Treasury Secretary Scott Bessent has said that keeping yields low on longer-term treasuries was a priority for the administration. They act as a benchmark for borrowing costs for everything from mortgages to student loans. Correct. Absolutely correct there. So again, masterful job by Scott Bessent here in managing the Treasury and thus managing the bond market itself. Just absolutely doing a phenomenal job here, which is great. So, okay, and then let's take a quick look at some of these yields here, shall we? So, again, 30-year T-bill still coming in at 4.714%. The 10-year T-bill has actually dropped down to 4.068%, creeping ever a little bit closer to that flat 4%, or hopefully just below 4% is what we're really looking for. Would be great if we could get that back down to 3.5%, but that's probably going to be tough. That is probably going to be tough this year, but still, we've done very good. Again, it's right where right at 4% there. That's really where we were looking for it to be at the moment. It's kind of bounced around a little bit the last couple of weeks, but it's stayed there. It's holding strong, if you will, for the moment. So all right, now let's go on. I want to talk about crypto for a minute because there's just some big things. We have seen a decrease in Bitcoin recently, and I just want to talk about these two articles here that were in the Wall Street Journal here the last 2 days. So the crypto trades that amplified gains are now turbocharging losses. Bitcoin's steep fall highlights the growth of risky bets offered by Wall Street and crypto firms alike. So the rally in crypto prices this year was boosted by a large heap of debt, with traders using leverage to amplify their gains. Now, after a punishing sell-off in the past 2 weeks, the dangers of those bets are becoming apparent. Investors have never had more ways to place complex wagers on crypto. In some cases, people can put down $1 of their own money to gain exposure to $100 of Bitcoin. It is a strategy that can produce windfall profits when the market breaks the borrower's way. If it goes in the wrong direction, traders can be on the hook for big losses and can see their holdings liquidated if they don't post sufficient funds. Daily total liquidations on crypto exchanges have been on the rise this year, but in October, they shot up to a record high, according to data from CoinGlass, after President Trump's surprise tariff announcement against China triggered a crypto sell-off that compelled exchanges to close out underwater positions. In the end, it really comes down to the fact that you can invest with more means than you have, but it also means that you will get punished for not managing your risks accordingly, said Nikolai Sundergaard, a research analyst at crypto data firm Nason. So again, here, this is what I was talking about. The price of Bitcoin so we hit our peak here at $122,000 plus on October 5th, and now we have plunged all the way down to a little under 85,000. So steep decline in Bitcoin here as we've had this sell-off here over the last 5 weeks or so. Total liquidation on crypto derivative exchanges daily. So you see this massive spike here just within the last couple of days. And it's just, within the last week, if you will. So again, huge liquidations here in some of these cases. So pressure on leverage traders has been one of the main storylines in crypto's recent skid. Bitcoin has lost roughly 29% of its value since hitting a record high above 126,000 in October, with investors' retreat from riskier trades dragging the largest cryptocurrency to a recent $84,000. It's the biggest low since April. The last 2 weeks have been really tough for a lot of people, said Kevin Wan, a 33-year-old individual investor who's been trading cryptocurrencies since 2013. Wan started selling Bitcoin short, betting on its decline. Once the token touched 106,000, he borrowed on a crypto exchange to give him 20 times the leverage on his trade. When Bitcoin fell, Wan said he made about $120,000. I've learned from previous cycles to put money away in places where you can't really access it, he said, because it's really easy to get into a mindset of revenge trading and then just having a downward spiral of performance when the market is hard. So, so again, we've got some concerns here in the crypto market, and then let's just take a look at this. So, it was supposed to be crypto's year. Then came the crash. So crypto market turmoil intensified this week, with Bitcoin shedding more than 10% and over $10,000 in value. So earlier this month, Cantor Fitzgerald chairman Brandon Lutnick presided over an unveiling of Satoshi Nakamoto to close out the first day of his firm's Miami Crypto Conference. At least it was a statue of the mysterious creator of Bitcoin, not the actual person, because we still have no idea who that was. Might have been the government. Just saying. Just saying. I don't know. Just saying. At the Ritz-Carlton, more than 200 bankers and investors gathered to see the artwork sculpted to resemble code out of The Matrix. Selfies were taken. Michael Saylor looked on approvingly. A string ensemble played New York, New York. Though the statue was sitting cross-legged with a laptop, a plaque beneath it read confusingly, "Always standing for freedom." Interesting. On that day, Bitcoin was down 19% since its October peak. It would fall further still, giving up all its gains for the year and leading a $1 trillion loss in digital currencies more broadly. The crypto market turmoil only intensified this week, with Bitcoin shedding more than 10% and over $10,000 in value in the 24 hours leading up to Friday morning. More than $2 billion worth of leveraged crypto trades were liquidated, pushing Bitcoin below 81,000, according to data from CoinGlass. The largest cryptocurrency is now on track for its worst monthly performance since June of 2022, when the collapse of crypto lender Celsius Network plunged the market into what became known as its crypto winter. Yeah, I mean, the failure of Celsius may have led to that, but if anybody's seen a shameless plug incoming, if anybody's watched any of my crypto series, I give the whole background on all this stuff. I did episodes on the crypto winter, talked about the companies that failed there, everything that went on with that. So what really kicked off the crypto winter, for the most part, was the failure of the USD stablecoin known as Terra. Terra USD basically blew up, and see, Terra had their own coin. The name of that coin is escaping me at the moment, but they had their own coin, and that coin blew up, kind of took down the exchange. It rippled through. You had a hedge fund called Three Arrows, which went down, but then you had 17 other crypto firms that went down with it. That basically led in the culmination of the implosion of FTX in late October, early November of 2022. But yes, I mean, obviously the blowing up of Celsius, that again was one of those catalysts that continued the complete implosion of Bitcoin and the Bitcoin market at large, if you will, during that crypto winter of 2022. But I digress. Some traders have said the drop in Bitcoin may be forcing some other selling in the traditional markets, which swooned this week. And again, another chart here showing the price of Bitcoin, which we just saw a few minutes ago. Every group chat I'm in, everyone wants to know who blew up, says Nick Carter, founding partner at Castle Island Ventures. You can't make sense of it at all right now. There's a general malaise with no exact catalyst to say this is why. This was supposed to be crypto's year. There was a perfect storm of crypto-loving White House, Wall Street adoption, and friendly legislation that put close to more than a decade of antagonist U.S. regulation and prosecutions. In a sense, it worked. And then here's a picture of, this is the statue they put out of Satoshi Nakamoto, which is supposed to be like, look like the Matrix. But again, we already got our answer. We got our answer from the first article here. Going back to the first article for a second here. So the crypto trades that amplified gains are now turbocharging losses. So we got our answer as to why this is happening, because people are betting against crypto right now. Crypto, it's classic Wall Street trading strategies. Bitcoin went on a great run, shot up to 126,000, and people go, okay, now it's time to sell off. Now it's time to take some of those profits. And then some of the traders get really greedy. Bitcoin comes down to around 103,000, and then they pile on the shorts. the shorts pile on, and then the shorts force it down to 84,000. But at some point, it will meet a resistance level, and then the trade will start go. And again, the people shorting it, the trade will start to go against them. It will reverse, and Bitcoin will start going back up, and then all those people who were short and heavy will take a bath. So again, we already know why this is happening. Do I think that this is another crypto winner, or we're about to see this blow up? No, not at all, not at all. I don't think that's really going on here right now. I think you're just having you people have made a lot of money this year. It's a combination of, you've got people taking gains off the table. They're selling some holdings, taking some of those gains, but then you've also got the greedy people piling in with the short trades right now. They're shorting Bitcoin. They're making money doing it for the moment. And that will continue, like I said, until we find a resistance level. And Bitcoin may drop more. It may drop down to 70,000 or even 60,000. Who knows? We'll still have to see. But again, this is not like an implosion of the crypto market. It's not. I don't view this as an implosion of Bitcoin. I just view this as kind of people in the crypto world applying normal Wall Street trading strategies to what's going on right now. So there's that. So that's what's going on at the moment in the crypto market. So we'll continue to keep an eye on that. Okay, I wanted to talk about private credit for just a minute. I've got some private credit news that I wanted to share with everybody. Just kind of some updates on some of the things that were going on there. Obviously, I've talked a lot about the issues in the subprime auto market as it relates to the private credit market itself, in terms of the failures of Tricolor Holdings, the failure of First Brands, the failure of PrimaLend, as well as 5 or 6 other companies in that mix. But let's look at this for a second. So this is from Investopedia. So this could cause the next big crisis in markets, the man known as Bond King says. So Jeffrey Gundlach, a bond market veteran, predicted private credit would be the cause of the next financial crisis during a recent podcast appearance. Private credit markets have ballooned since banks tightened lending standards in the wake of the global financial crisis. So a credit market veteran known as the Bond King has a warning for Wall Street. The next big crisis in the financial markets is going to be private credit, said Jeffrey Gundlach, CEO of Double Line Capital, on an episode of Bloomberg's Odd Lots podcast released Monday. It has the same trappings as subprime mortgage repackaging had back in 2006, he said. The U.S. private credit market, in which investors loan money to businesses in return for interest payments, has exploded in recent years, growing from $46 billion in 2000 to about $1 trillion in 2023. Actually, it's now up to $1.7 trillion. I've had more current figures there that I have shared with everybody in the past weeks. It's a $1.7 trillion market right now. Morgan Stanley estimates the market was about $3 trillion at the start of 2025. So their numbers even almost double what I have. So over the past 10 years, private credit's risk-adjusted returns have significantly outpaced the rest of the bond market, according to Morgan Stanley. Concerns about the health of the market have been heard before. In September, 2 corporate bankruptcies wiped out billions of dollars from bank balance sheets and raised questions about non-bank lending standards. When you see one cockroach, there are probably more, JP Morgan Chase CEO Jamie Dimon warned at the time. Months earlier, Dimon had cautioned that private credit's risks, the opacity of its credit ratings, its leverage, its illiquidity were a recipe for a financial crisis. There's no way to know when a private credit crisis will erupt, said Gundlach. It's impossible to be both right on the direction and correct on the timing of financial trends, he said. He notes he became skeptical of mortgage lending in 2004, 3 years before the subprime crisis began. So these things take forever, and it goes on much longer than you'd think. Yes, I think he is 100% spot on with this. And this echoes exactly what I have been saying for this entire year, that the private credit market is a big problem and it is going to blow up. I think you are seeing right now, to concur with what he just said here in this article, I've said you've just seen the first few dominoes fall. You've just seen the first few dominoes fall. There is a giant steaming pile, a bag of excrement, you know what, sitting there right now, and it's nasty. And again, to follow his comments here. You do see a lot of similarities between the private credit market and what was going on back in 2006. So again, I don't think that is a bad or an illogical comparison there. I think that might prove to be very spot on. Now, let me just share everyone a couple of news clippings this week on private credit. So, Blue Owl Capital Corp has halted redemptions in one of its initial private credit funds as it plans to merge it with a larger vehicle, a move that may result in significant losses for investors, the Financial Times reported. Now, I can tell you as an update, this did not happen because this did not go over well with investors. Investors went back to Blue Owl Capital Corp and basically said, no, you are not going to merge those two funds, and you're not going to cause us to take unnecessary losses in that bond portfolio, basically. And so again, not a good thing there. So let's look at a couple other things here. So if I can, I've got a few others. Okay, so trade finance platform Raystone Inc. is looking to sell itself due to a liquidity strain it has faced since the collapse of its biggest client, First Brands Group, LLC. Bloomberg News reported, citing an investor presentation reviewed by the news outlet. So trade finance platform Raystone looking to sell itself due to a liquidity strain. A telecommunications executive, Bakram Brakmahamat, whom BlackRock Inc. subsidiary HPS Investment Partners LLC and other lenders had accused of fraud, is under criminal probe by federal investigators led by the FBI. Another private credit transaction. Jefferies Financial Group is shopping as much as $1.2 billion in debt for power infrastructure companies, Forgent Power Solutions and Central Maloney LLC, to take loans out of the hands of direct lenders. Another thing related to the private credit market. Let me see what else I got here, because I know I had a couple other things. Several commercial properties associated with problematic loans at Zions Bank Corp and Western Alliance Bank Corp have been placed under court receivership. Bloomberg Law reported, again, related to the losses from private credit. Blue Owl Capital Corp and Blue Owl Capital Corporation 2 terminated the merger agreement, like I just said, terminated the merger agreement between the two investment companies, citing recent market volatility. Yeah, and their investors saying no. BlackRock has waived management fees on a portfolio of private credit loans due to significant underperformance, Bloomberg reported. The asset manager, which funded these loans through collateralized loan obligations, CLOs, our old friend there, CLO, from back in, if you remember, back in 06, 07, collateralized loan obligations, faced a decline in portfolio value that caused it to fail an over-collateralization test in October. So BlackRock's got some issues there. And then strict regulatory requirements have forced banks to merge and pushed lending out of the banking system and into private credit, according to the Federal Reserve's newest governor. Yes. Yes. And then let's see here. U.S. bankruptcy judge Christopher Lopez in Houston ordered an independent investigation into bankrupt U.S. car parts maker First Brands Group, LLC, allocating a $7 million budget to probe allegations of fraud involving the company's use of third-party financing for customer invoices. Reuters reported First Brands' bankruptcy filing has raised concerns about OPEC financing in the private credit market and highlighted potential losses for financial institutions, according to the report. BlackRock, again, waived some management fees on a poorly performing private credit loan portfolio after it breached an over-collateralization test in October, Bloomberg reported. The portfolio, BlackRock Baker CLO 2021-1, contains loans to several troubled companies, including recently bankrupt Renovo Home Partners. So, yes, we got a lot of crazy stuff happening out there right now. And I just found something else I want to share with you guys, but I'm going to come back to that in a minute. So again, just getting back to the private credit market, there are issues here with this market. There are a lot of issues, and we have to keep an eye on this. We will keep an eye on this. Now, let's get into the AI situation for a few minutes here, because as I've said, I flat out believe that there is a bubble in AI now. I think that the actual it's kind of crazy because I think that the earnings report this week from Nvidia actually there was a great earnings report, but it also confirmed all of the problems that everybody's afraid of. That's why Nvidia stock was dropping yesterday. But I just want to show this to you. So this was something that was posted on X probably a couple of weeks ago, but I thought it perfectly illustrated, the infinite money glitch. OpenAI, 100 billion to Oracle, Oracle, 100 billion to Nvidia, Nvidia, 100 billion back to OpenAI. It's just this circular loop of funding right now between these AI companies, and and the amount of just kind of crazy financing activity that they've got going on is pretty wild. Now, I want to show everybody something else here. I want to hang on here. I got to stop this for a second because I want to show everybody this other thing here. Let's see here. Yes. Okay. Bang. Okay. This is a chart here. How NVIDIA and OpenAI fuel the AI money machine. And I know this is a little low. I'll try to blow this up a little bit if I can, and we can kind of look down here. But just look at this thing. Look at this thing. You see, and NVIDIA is at the heart of this thing with this 4.5, now $5 trillion valuation. But you see, OpenAI here. We see AMD, we see XAI, we see Oracle, we see Intel, CoreWeave, Nscale, Mistral, Figure AI. What do we have here? Harvey AI, Ambience Healthcare, AnySphere, Nebius, Microsoft. They're all involved in this kind of what has become this incestuous circle of money just going around. And I've displayed many of the articles to everybody over the last few weeks where, everybody gets an instant stock pop. They instant like, oh, NVIDIA is going to do a deal with XAI. Oh, boom, but their stock pops up. Oh, this is great. More AI. And as long as AI is in the headline, and as long as they say that some investment is related to AI, it's instant gravy for your stock price, So, and again, and you see this whole thing going on. And I love to look at this chart here because I feel like this chart perfectly illustrates what I'm talking about in terms of these crazy financing deals that are going on in between these companies. And you can just see that this has become absolutely, this is a bubble. So let's see here. We shall come back to that in a minute. I want to bring some other articles up here for you guys here for a second. If I can get back to find the right one here. Where am I at here? Studios. Yeah, here we go. Okay. All right, so come back to this. All right, let's jump over here to some of these. So Oracle was an AI darling on Wall Street. Then, wait for it, reality set in. So shares have lost gains from a September AI-fueled pop, and the company's debt load is growing. Yeah, their debt load is insane right now. It's insane. So Oracle has never given up gains this big, this fast. Investors nervous about the scale of capital that technology companies are plowing into artificial intelligence infrastructure rattled stocks this week. Oracle has been one of the company's hardest hit. Shares in the software company popped more than 30% in September when the company disclosed a $317 billion revenue backlog. The Wall Street Journal later reported that most of it came from a deal with OpenAI. Since then, Oracle has lost all of that ground and then some. And so we can see here from this chart, percentage change from all-time highs, select AI-related stocks. You can see that these companies have all taken a hit here. Meta, Palantir. Now, obviously, Michael Burry from The Big Short fame, he kind of has been blowing people away. Michael Burry is one of those guys where when Michael Burry doesn't say very much, and when he does, you should sit up and listen. And he basically said, hey, I closed out my whole portfolio and I'm going all in. He completely shorted Palantir and Nvidia, just going right after him. And of course, the CEO of Palantir, he went nuts. He jumped on CNBC and was like, I can't, this is crazy. So it was actually pretty amusing, actually. But he freaked out about it, which was pretty funny. That was just a hint. That's not the way to convince your investors that Michael Burry was wrong. Actually, you reinforced the fact that he was right. But we could see here that AMD, Palantir, Meta, Oracle, Oracle would be down 31%. So, in nearly 4 decades as a publicly traded company, Oracle has posted one-day gains of 30% or more 3 other times. It has never faded back to its pre-pop close until now, according to Dow Jones market data. And that is just its stock. The company needs to borrow billions of dollars to pay to build the infrastructure it needs to serve OpenAI and other AI customers, recently selling around $18 billion in new investment-grade bonds after the new issuance. Oracle's outstanding debt load surpassed $100 billion, making it the most indebted big tech company with an investment-grade rating. It is burning cash and will still need to borrow billions more to meet its dividend and capital spending commitments. Oracle declined to comment. Shocking. Moody's Ratings and S&P Global Ratings have edged closer to reclassifying the company's bonds as junk debt. You got that? Junk debt. Oracle is also projected to run up a big tab with its future data center landlords. One of them borrowed $38 billion recently to build 2 data center campuses where Oracle will be the tenant. Here you can see Oracle's adjusted net debt. Let me blow this up here if I can a little bit, make that a little bit bigger for everybody to see. Total leases and liabilities, net balance sheet debt. I mean, you just see here 26, 27, 28. I mean, it's just the debt is just ballooning. And the crazy thing is, like, they need more money. Like, they need more money to keep this thing going, man. They're not going to be able to just stick with it. And then let's look at OpenAI revenue versus free cash flow annually. So you can see a revenue, free cash flow, and this is 2030. Right now, they're burning cash. Their revenue's going up, but their free cash flow is negative. They have just done nothing but lose money. And of course, it's always a projection way out in the future of them making money, way out into the future. I mean, this is 2030. This is another 5 years down the road before they start making a dime. So again, this is what's giving everybody pause. They're looking at all this and going, wait a minute, this has gotten completely out of control. Like, this doesn't make any sense. Now, let's look at NVIDIA for a second. NVIDIA's best wasn't enough to prop up a wobbly stock market. The tech juggernaut's results sparked a furious rally and then a slump. So the artificial intelligence trade is still in trouble. Blockbuster results from AI bellwether NVIDIA sparked a furious rally from Tokyo to New York early Thursday before indexes reversed course and tumbled in the largest blown gain since April's terror-fueled market turmoil. The sharp move extended a painful stretch for the stocks at the heart of the AI boom, demonstrating how on edge investors remain over their swollen valuations and aggressive spending plans, which some fear mark signs of a bubble. Adding to the worries on Thursday, a shutdown delayed jobs report ended a weeks-long backlog on key economic data, but did little to clarify the state of the labor market. For a while, investors cheered the dissipating fog, with the NASDAQ composite surging as much as 2.7%. Then tech shares slumped, driving the index to a 2.2% decline. NVIDIA climbed as much as 5% before finishing the session down 3%. Bitcoin slumped anew to its lowest 4 p.m. level since April. The COB volatility index, known as Wall Street's fear gauge, rose around 12%. What stands out to me is the lack of any substantial shift in narrative to cause such a big shift, says Tony Roth, Chief Investment Officer at Wilmington Trust Investment Advisors. There's just not a lot of confidence in the market right now. Yeah, no dud. What stands out to me is the lack of any substantial shift in narrative. Yeah, man, there's been a big shift in narrative. It's everything I've just been talking about is been the big shift in the narrative. Yeah, no doubt. The shift in the narrative is people are starting to open their eyes to the fact that this is insane. The amount of money that is being plowed into this, and I hate to break it to people, there's no pot of gold at the end of the rainbow here. It's not there. I have studied enough about AI in the last year, and I've been reading enough books on it to understand that basically, they're all selling us on this idea. Super intelligence is there, and it's right around the corner. And these guys you have to remind yourself that these guys are salesmen. This guy right here, this guy's the number one salesman, Jensen. This dude, he gets up there and he is selling it all day long. Oh God, got to get the chips out there for the AI to build the super intelligence. And this is what we need to win the AI arms race. They create the competition and they pump it up, and it's all sales tactics. It's like, oh, we have to win the AI race. If we don't win the AI race, we're all doomed. But then we could be doomed if we win the race. Like, it's the whole thing is nuts. And and it's just, and again, this is I keep saying, like, this, I do not have a doubt in my mind that this is a bubble, and this has reached a crazy level, and it will pop, when people basically say, like, when the results don't come, when another year goes by and they're still spending like just absolute drunken sailors, trying to build these data centers, trying to get them up. And then we're going to have the energy problem. Okay. The energy problem is going to kick in, because regardless of all the spending, regardless of all the development of all these data centers and everything, these guys are going to start siphoning off all the energy. And it is going to drive up our energy prices. It's going to drive up our energy prices big time. And we're going to get stuck in a situation where these guys are basically going to run out of money, because people are going to look at it and they're going to go, yeah, guys, you have spent trillions of dollars and we still don't have anything to show for it. And you guys are telling us that you want to just keep spending trillions more, and you're lying in your pockets, like you're getting fat, dumb, and stupid rich. But the rest of us, our energy bills are now starting to go through the roof. That's where this is leading. That's where this is all leading. And it's not going to be pretty. It's not going to be pretty when we get there. And some people, like I said, just some people are starting to wake up to this. But like I said, I have no doubt. I have no doubt. All right. Let's take a break for a minute here. This is the point in the show where I basically like to tell everybody the economic data that's coming out, economic indicators that are coming out for this week. I also like to go over the episodes that I put out this week. So I want to jump over to my other document here. Okay. So let's run through the 5 episodes that I put out this week real quick. So on Monday, I did what I thought was, I did a couple of what I thought were very important episodes this week. On Monday, I did the CRE, commercial real estate maturity wall, continues to shift with 2026 coming into focus. So the CRE maturity wall was created by the increase in interest rates from the Federal Reserve starting in 2022. The increase in rates caused banks to do what's called extend and pretend, hoping that the Fed would eventually bring down rates, making it easier to renew and roll over existing commercial real estate loans. This action pushed CRE maturities out to 2025 through 2027, thus creating what is known as the maturity wall. Now, the CRE maturity wall continues to shift, with 2026 now becoming a big year. And this episode basically looks at a couple articles from S&P Global on the maturity wall issue. But again, we're going to see the maturity wall in the next 4 years. Whole lot of commercial real estate that's got to get refinanced. And I think the reality is beginning to set in that we are not going to get back to 4% rates or 4.5% rates. We might not even get back to 5% rates. Maybe we get down into the 5s. Maybe we get down to 5.5. But I think that's about your floor. I don't really see us going down much lower than that, unless we have some kind of absolute catastrophe, right? The AI bubble blows up, the private credit market blows up, and then maybe we have to have some kind of huge bailout, and then maybe that ends up the Fed dries interest rates way down again. I don't know. Outside of that, I'm hoping that doesn't happen. Outside of that, again, I think I see interest rates, maybe coming down to around 5.5%, but that's probably where you are. So regardless, if you're sitting on one of those primo rates right now, if you're sitting at 3.75, 4%, 4.25, if you're sitting on one of those primo rates, the reality is when that thing's done and that debt gets rolled over, you're getting rolled over at a much higher rate than you were at. Now, slightly more palatable rate, okay, you're probably somewhere at 6.25, 6.5. It's a much more palatable rate, but still a higher rate nonetheless. It's going to cost you more debt service and so on and so forth from there. So that was discussion on the CRE maturity wall. I thought that was a very, very important episode. So if you did not get a chance, go check that one out. Then on Tuesday, I did BlackRock writes off $150 million Renovo loan as private credit woes continue. And this is what I was just talking about a few minutes ago. So another one of those one-off events occurred as BlackRock wrote off its entire $150 million investment in Renovo Home Partners. Another blow up in the private credit market. In addition, we check in on the ongoing lawsuits and fallout from the First Brands collapse, BDO's role as the auditor of First Brands. Major U.S. insurers continue to gobble up private credit deals. Wall Street's reaction, and then Blackstone offloads a $1.8 billion investment and takes a $600 million loss. So all so that episode talks about that BlackRock write-off, but also serves a little bit of a private credit market update at the same time. Then on Wednesday, I put out an episode called Outlook for 2026. So this episode provides an outlook for 2026 by covering the following topics: sustainability, mergers and acquisitions, supply chain, equities, meaning stocks, debt markets, AI, commodities, and private credit markets. This is a sneak peek at what some of the major challenges, issues, and opportunities will be for 2026. This episode reviewed a series of articles from S&P Global, which was titled Big Picture 2026. So again, great little sneak peek there at 2026. As we get closer to the end of the year, like that, probably the week of Christmas, as we get into New Year's, I will do as I did last year. I will do kind of a year in review episode, just looking back on this year, what happened. Take a sneak peek at 2026, maybe go into some of the things like how do I think 2026 might play out. So we'll have that toward the end of the year. But in the meantime, if you want a sneak peek at what's potentially to come in 2026, go check out that episode. Then on Thursday, I put out how can you boost the profitability of your best customers? So most banks across the U.S. are facing some level of margin compression. As a result, it is becoming increasingly more important to understand who your most profitable customers are and how you can boost their profitability. So this episode reviews an article from Bank Director titled Figuring Out Who is Profitable and Who is Not, a Banker's Guide, and a report from White Clay titled Customer Profitability Insights. So, and again, White Clay, for anybody who didn't see it, I actually did an interview with their CEO, Mac Thompson. Mac was a great guy, good friend of mine. He was kind enough to come on and do an interview talking about White Clay and what they do. And I knew that they were kind of doing this little joint research with Bank Director. And when this came out, it was something I really wanted to cover. But I also think it was just a great topic, how to boost the profitability of your best customers. Part of it is the Pareto rule, what's also known as the 80-20 rule. 80% of your revenues and profit come from 20% of your customers. So it's not just about identifying who your best customers are, but it's how can you get more profit, or how can you make more money from those customers? How can you deepen those relationships with your best customers to generate more revenue and more profit? So that's really what we're focusing in on in that episode. So again, I think very good episode to look at. And then finally, yesterday, I did a great interview with David Danielson, who is one of the managing directors at the Kafafian Group, which is a small investment bank here in Pennsylvania. But Kafafian Group was started by Robert Kafafian. Bob, great guy. But David Danielson's kind of came in there, and he's, doing his thing, if you will. But we had a great conversation. And so during the interview, we discussed factors that will boost the bank M&A market in 2026, what is driving M&A pricing, why larger banks trade at a higher multiple, why interest, what are called yield marks, discourage deals, how big was the equity hit to available for sale securities in 2022, and will we see another wave of bank M&A? So I pointed out that Dave has more than 25 years of experience advising financial institutions on strategic growth, financial performance, and enhancing shareholder value. So I thought that was an absolutely fantastic interview that I did with David. I hope everybody will go and check that out because it was really, again, it was really good. David was brought in basically like a PowerPoint presentation. We went through a number of charts and graphs. So it was, just a really great interview. I really appreciated him taking the time to come on and talk with us. So provided some absolutely fantastic insights. So those were the 5 episodes that I put out this week. Also, you might want to check out, I put out a couple of bonus BND Strategy Room episodes this weekend. One came out today. I think it was an upstate. I think it was update on Epstein, how Jeffrey Epstein is affecting some of the largest banks in the country right now. So and then I've got a couple more bonus episodes that are going to be coming out. Basically what they are is the bonus episodes are just clips from the live stream. So I might take a 5 or 10 minute clip from the live stream, just put that into a little short episode and put it out there. Mainly for people, like if you've never watched the live stream, I'm trying to give people a little bit of a flavor for it. But if you do watch the live stream, maybe if you didn't get a chance to watch the whole 2 hours, maybe if it was a segment that you missed, I put it out there so you can check it out, have it in a kind of more manageable bites, if you will. So, but anyway, okay, keep an eye out for that. So, all right, what are the economic indicators coming out this week? So on Monday, November 24th, we have the 2-year Treasury note auction. On Tuesday, November 25th, we get the core PPI, core retail sales, PPI for September, retail sales for September, CB, consumer confidence for November, pending home sales for October, 5-year Treasury note auction. On Wednesday, November 26th, we get building permits for September, durable goods orders for September, GDP for the 3rd quarter, goods trade balance for September, Chicago PMI for November, core PCE price index for September, new home sales for September, the 7-year Treasury note auction, and on Friday, November 28th, we get the Fed's balance sheet. So we got a lot of stuff rolling out hot and heavy this week. So it's been a while since we got some of that data. I'm going to share with you guys the jobs report for September, which came out, which is actually pretty good. I'm going to share that in just a couple of minutes after we go through our banking news here. But that was really the only thing. We got some trade balance information too. Those were really the only couple of things that we really got this week. But this week coming up, like I said, we've got a ton of economic indicators coming back out as they begin to start to catch up with a lot of the numbers that were not coming out. So, okay, first thing I wanted to point out, I had talked about last week about the Federal Reserve Bank of New York kind of called this emergency meeting on the repo market. I talked a lot last week about the repo market, so I just want to read this to you guys for a second. So Federal Reserve Bank of New York President John Williams held discussions with Wall Street banks this week regarding the standing repo facility, Reuters reported, citing a New York Fed spokesperson. Williams convened primary dealers to engage in dialogue about the standing repo facility's role in monetary policy implementation and to gather feedback on its effectiveness for interest rate control, the report said. Now, that sounds nice. The real reason I could tell you right now for that meeting was because like I showed last week in some of the repo charts, you have seen these massive spikes because the Federal Reserve, as I pointed out, in decreasing their balance sheet, they drained all of the money out of the repo market. And that's a problem considering the fact that the Federal Reserve decided to put the repo market at the very center of market liquidity. That's what you have to understand. The Fed did that. That was the Fed's choice. Now the Fed's coming back, basically saying to these guys, hey guys, we're trying to understand a little bit about the role here of the Fed, of the repo market in monetary policy implementation and, trying to gather feedback on its effectiveness for interest rate controls. No, they're basically going, yeah, guys, if this starts to, crap the bed, we really need you guys to let us know what's going on over here. Okay. So that's what's going on with that. Okay. All right, let's get into some other banking news here for a second, but hang with me for just a second here. All right, there we go. Let's roll here. Existing home sales increase in October. So existing home sales increased by 1.2% in October, and we're up 1.7% from a year ago. Mortgage rates edged up in the latest weekly report. The rate for the 30-year fixed rate mortgage averaged 6.26% this week, up from just 6.24% last week. So not much of an increase, but just a tad bit. Senate panel signals Selig's nomination to lead the CFTC. So the Senate Agricultural Committee advanced the nomination of Mike Selig to be chairman and commissioner of the Commodity Futures Trading Commission. ICBA and others share recommendations on curbing illegal robocalls. So ICBA and other groups sent the Federal Communications Commission recommendations to improve Stir/Shaken, a call authentication framework for the telecommunications industry designed to curb illegal spoofing of the phone number shown by caller ID. So very interesting. We'll keep an eye on that. Treasury and IRS issue guidance on the ACRE Act tax exclusion. So the Treasury Department and IRS issued interim guidance for the ICBA advocated ACRE Act tax exclusion for agricultural lending passed under the One Big Beautiful Act. So the One Big Beautiful Act added a section to the Internal Revenue Code that allows lenders to exclude from gross income 25% of the interest they receive from loans secured by rural or agricultural real property. The ACRE Act exclusion, long sought by ICBA, was enacted under Section 139L of the OBBBA, the One Big Beautiful Bill Act. So, okay, so that's good. We'll keep an eye on that. Trump nominates new CFPB head. I'm going to talk about that a little bit later, but Donald Trump nominated Stuart Levenbach to be director of the Consumer Financial Protection Bureau for a 5-year term. However, CFPB may not be around that long. We shall see. Fed's Mirren endorses community bank regulatory relief. Yes, absolutely. Love that. Senate panel advances Travis Hill nomination for FDIC chair. So the Senate Banking Committee advanced the nomination of Travis Hill to be FDIC chairman. The nomination now heads to the full Senate for a final vote. Fed officials mixed on December rate cut. Yeah, of course they are. Yeah. Builder confidence flat in November. New York Fed business activity down in early November. OCC confirms permissible bank activities related to paying crypto asset network fees. The OCC confirmed permissible bank activities related to paying crypto asset network fees and said that a national bank may hold amounts of crypto assets as principal necessary for testing otherwise permissible crypto asset related platforms. Very, very interesting there, confirming some of those details. Fed details new supervisory principles. The Federal Reserve released information regarding new operating principles for bank supervision. The Fed said the principles, which were provided to all supervisory leadership, prioritize Fed staff attention on a bank organization's material financial risk rather than process or documentation issues that are not material to safety and soundness. Reduce duplication resulting from exams and supervision by both Fed staff and by other state or federal banking supervisors, and require Fed staff to prioritize deficiencies that could have a material impact on a firm's financial condition when issuing matters regarding board attention, and prohibit Fed staff from communicating MRAs in vague or overly broad language. Love it. Fantastic. House panel holds hearing on deposit insurance reform. Now, you might note that I just did an episode on this. You might want to go check that out. The House Financial Services Committee discussed a wide array of issues during a hearing on deposit insurance reform, including supporting community banks and improving the bank resolution framework. In his opening remarks, Committee Chairman French Hill said the panel's guiding principles should be to ensure the stability of the banking system, maintain depositor confidence, fairly apportion costs, enforce market discipline, and reduce moral hazard. Yet it's kind of an oxymoron. You're not going to reduce moral hazard by increasing the insurance coverage of it, basically increasing the bailout, if you will. Doesn't really work that way. After second credit union acquisition in 2 days, ICBA demands a policy response. So with large credit unions announcing 2 acquisitions of Main Street community banks in as many days, ICBA said it is time for Congress to eliminate the federal tax exemption for credit unions over $1 billion in assets to prevent further harm to local communities. Yes, could not agree with that more. New York Fed survey shows solid business growth in November. ICBA supports housing bill, suggests changes to ROV section. So ICBA signaled support to the road. What is this called? For the Road to Housing Act of 2025, which would expand housing opportunities and address longstanding affordability challenges, though they raised concerns with the section that would codify into statute the reconsideration of value process for property appraisals into the Truth in Lending Act. So we'll have to keep an eye on that one. ICBA mega credit union acquisition signals it's time for a policy response. Yes, we just went over that one. ICBA shares deposit insurance priorities with lawmakers ahead of House hearing. So ICBA told Congress that raising deposit insurance limits will bolster depositor confidence in community banks. In a statement for the record ahead of today's House Financial Services Committee hearing on deposit insurance reform, ICBA and 25 state affiliates said permanent solutions to deposit insurance reform will proactively bolster the safety of our nation's financial system. So, okay, there you have it. So, that's a lot of the bank news I have for this week, guys. So we'll definitely have more here before we get to the end of the night. Hang in there. So we're going to get back to our articles here now. I still have a lot of stuff to run through. So let's get into here. Let's get into this for a minute as we continue on here with our news, as it were. So, and remember, everyone, buckle in. We're only here for another 4 hours, so just get cozy, get comfy. You got a long ways to go. just kidding. All right. So the middle class is buckling under almost 5 years of persistent inflation. Workers growing tired of economy in which everything seems to get more expensive. Yes. America's middle class is weary. After nearly 5 years of high prices, many middle class earners thought life would be more affordable by now. Costs for goods and services are 25% above where they were in 2020, even though the inflation rate is below its recent 2022 high. Certain essentials like coffee, ground beef, and car repairs are up markedly this year. Life felt more doable a year and a half ago, said Holly Frew, a college communications director with a household income of around $135,000 living in Atlanta. I need to know where the light is at the end of the tunnel. The American middle class encompasses a broad cross-section of workers and includes white-collar office employees, nurses, and plumbers, although there is no universally accepted definition. Pew Research Center defines the middle class broadly as having a household income between about $66,000 and $200,000, depending on where they live. Perpetual sticker shock is making many within the group feel worse about both their own finances and the future of the country. They are hunting for bargains and spending more carefully. Cost of living issues also push voters this month toward candidates who promise to address what many now see as an affordability crisis. Similar issues dogged Joe Biden's reelection campaign last year and have recently weighed on President Trump's approval ratings. The frugality of the middle-class customer figures as a recurring theme in recent corporate earnings reports. Fast food restaurant Wingstop said this month that middle-income diners have now joined lower income ones in dialing back purchases. Target reported slumping sales and said customers are spending cautiously on discretionary items such as home decor and apparel. Walmart, meanwhile, posted strong sales as consumers from all income groups flocked to the retailer's value. The University of Michigan's Consumer Sentiment Survey showed that 44% of middle-income respondents said their financial situation was worse than it was a year ago, while 23% said it was better based on a 3-month average ending in September. Those who feel worse off overwhelmingly said it was because of higher prices. So their gloomy outlook was in contrast with most affluent families who are enjoying stock market gains and powering the economy with their spending. Many in the middle class also have stock investments in retirement funds, but they are more apt to feel pinched and resentful of rising costs of everything from the price of a steak to a new couch. So, all right. So I've got a couple more articles here echoing this theme. But I just want to remind people because I don't like class warfare. I think that we absolutely have an income inequality issue in this country. I mean, the top that the top 1% of the wealth has a just mind-numbingly staggering amount of wealth compared to the bottom 50% in this country. And it is just an enormous gap at this point, and it's a problem. It's a major problem that has to be evened out in some way, shape, or form. So, I'm not, I'm not one of these. Again, I'm not. I'm not one of these. So we got to steal from the rich to give to the poor. I'm not down with that. I think what you need to do is you need to even out taxes. You need to reduce regulation. You need to make it easier for people to live in the middle class. You need to make it easier for lower income people to get into the middle class. These are things that need to be done. But right now, we do have an affordability crisis. We have, because understand, for people who are under the age of 40, there's been a lot of news this week about, for your average age of your first time home buyer is now 40 years old. I mean, that's crazy, because that's way too old. That is way too old. What's going to happen is, if people have to wait until they're 40 to buy a house, most people they're just not going to buy a house. They're never going to buy a house. Like you're telling me they're going to be, if they start working in their career or whatever, their job, when they're 22, you're not going to tell me that they're going to spend 18 years working in that industry before they buy a house. No way. That is not going to work. And I think this is what you're seeing in terms of President Trump's polling. And I think there needs to be some acknowledgement out of the White House that, yes, we do in fact have this affordability issue right now, and we are trying to fix it. But they need to emphasize the fact that, yeah, Joe Biden left us this giant turd burger. Okay, he left us this giant turd burger of an economy and a horrible situation, and now we have to try to fix this mess. And you're not, unfortunately for everybody, you're not going to fix this mess in a year. It may not be fixed in 5 years. It may not be fixed in 10 years. It may take a while, but at least you have to acknowledge the problem, and you have to try to lay out a path as to how you're going to address that problem. How are you going to get it done? And as I said last week, some of the things being bandied about were, we'll do 50-year mortgages, and we'll do 15-year car loans, and hey, we'll make it cheaper for whatever. I mean, this stuff was number one, these ideas were stupid, and number two, it was just ridiculous. Who is going to finance a car for 15 years? What bank is going to finance a car for 15 years? It's so mind-numbingly stupid. It's never going to work. You have to bring prices down. You have to make things more affordable for people. That's the bottom line. And unfortunately, I think people need to understand the way that you're going to get. We've had this little thing called an immigration crisis in this country. We've let in like 30 million illegal immigrants into the country. When you do that, you cause an unaffordability crisis. Okay, because it creates an artificial demand for everything, for cars, for houses, for your basic consumer products. It causes your hospitals to get overrun. This is what happens when you bring in 30 million people just like that. Even if it was done illegally, you bring in 30 million people instantly like that over the course of just a couple of years, you're going to end up with these problems. So in order to reverse said problem, you have to remove said people that shouldn't be here. When you take those people out of the equation, things will start to come back down. But unfortunately, you have a lot of people out there that they don't want to hear that, because now they've viewed this is now a humanitarian crisis. And I would just say, well, it's not a humanitarian crisis that I created. There are a lot of people in this country that did not want this. That basically said, no, we can't do this, but it happened anyway, and here we are. So now, unfortunately, if to get it back to where it needs to be, we're going to have to do some, there's going to have to be some pain. There's going to have to be, some very uncomfortable things are going to have to be done to get this back to a situation that is affordable for everybody. Yes, there are a lot of things that can be fit. You can reduce regulation, you can reduce interest rates, you can do this. That is all well and good, okay, but you have to. It's a supply and demand issue. You've got too much demand on too little supply, so you need to remove some of the demand. Okay, you need to remove some of the demand from the equation, and then the supply and demand will begin to balance itself out. And that's fortunately or unfortunately, but that's the reality of what needs to happen. But but again, it's the messaging, from the White House right now. The messaging is just, it's not working. It's not working for a lot of people out there right now. So, but let's look at a couple other things here real quick. So, child care costs are higher than rent for millions of Americans, an analysis finds. Yeah, I didn't need an analysis to tell you this. I could have told you this over the last 15, 16, 17 years. As I was going through, I personally had a number of kids in daycare for a long time, and I can tell you I spent more on daycare than I did on my mortgage. And I can't even, it makes me sick sometimes thinking about the amount of money that I spent on that. It's insane. And I can tell you right now that most people cannot afford to do that. Most people cannot afford to spend the money that is needed on the child care. Now, on the one hand, I would prefer, in my perfect world, I would prefer that one parent in the household would be able to go to work and earn a living wage that would be able to pay for said family. That's my perfect household. And then guess what? You wouldn't need daycare because you would have a parent at home that would be there taking care of the kids until they were of an age that they could go to school. So that's how I would like to see things in my perfect world. But that's not the reality of our situation right now. The reality of our situation right now dictates that two people, that every household basically needs two incomes to make things, make ends meet, so to speak. And at the same time, even that's not enough, because even with the two incomes, people still can't afford the child care because of how expensive the cost of daycare is. American families spend between 8.9% and 16% of their income on full daycare for just one child. Millions of Americans pay more for childcare than rent every month, according to a new analysis by online lending marketplace LendingTree. Researchers found that childcare costs exceeded the cost of a two-bedroom home or apartment for families with two children in 85 of the 100 largest metropolitan areas examined. The biggest imbalance for families with two children occurred in Omaha, Nebraska, 111.3%, Milwaukee, Wisconsin, 110.9%, and Buffalo, New York at 105.6%. Spending almost $1,300 a month on childcare is a massive burden for parents. Now, keep in mind, that's one child. That's just one child. But most families don't have another choice. LendingTree chief consumer finance analyst Matt Schultz said they can't stay home. They don't have family or friends they can rely on for childcare. They have no other option but to spend a significant amount of money each month on childcare. It makes an already difficult financial situation that much more challenging. Infant care was found to be more expensive than rent in 11 major metropolitan areas. Infant care costs exceed rent the most in Springfield, Massachusetts, where the average cost of infant care was $1,996, while the median rent for a two-bedroom home or apartment was $1,734. And again, I don't need to go through all the examples of this. I mean, everybody gets the point, gets the idea here. But childcare is insanely expensive, and in a lot of cases, if you've got 2 or 3 kids going to daycare, that bill is going to be $3,000 a month, and a lot of times that bill is going to be more than what you're paying in your mortgage every month. So it's huge. And I often joke that after my kids stopped going to daycare, I felt like I was a millionaire. I felt like I got a ginormous you feel like you get a ginormous wage increase. Is wild. But it's just, but it just goes to show you. I mean, again, this is the problem. Like, this is what's killing people, is the fact that, like, you can't afford to buy a house. You got these crazy daycare bills. The cost of everything is going up. It's not. It's just, this is not putting people in a situation to have families and be successful. Now, conversely, and I'm going to say something here. The people getting squeezed again are your people in the middle, right? The people in the middle here are the ones getting squeezed. The wealthy can afford it. Okay, they may not like it, but they can afford it. The low income people, they are actually getting incentivized for having the more kids. Okay, the more kids they, if you're on welfare and everything, and I might have an episode coming out about this. But if you're on welfare and everything, you're incentivized to have more children. The more children you have, the more money you get, the more coverage you get from Uncle Sam. So you get incentivized for that. But the working class people, this is the reason why our birth rate is going plunging through the floor, because all of your middle class people, the people that do it the right way, the people that are out there working every day and paying taxes and everything else, they're getting crushed, and they're making decisions where they're going, you know what? We'd love to have. I'm sure there's a lot of people out there that would sit there and go, we'd love to have 4 kids, 5 kids, 6 kids, but they don't. They don't, because they can't afford it, because they sit there, maybe they have 1 kid or maybe 2, and then they go, okay, we'd love to have more kids, but we can't, because we just can't financially afford it. We have to be able to pay for everybody here. And this is the crux. This is the very crux of the problem going on in America right now. And something has to be done about this affordability crisis. We have to find a way to get us back to the days when we can, you can have one person working in the household and would pay for everything. And don't say that that's impossible, because that's what I grew up with. That's what I grew up with almost my whole life. The 70s, the 80s, the 90s. It wasn't really until, I would say, basically, it wasn't really until, it definitely gained a lot of steam in the 90s, but it was, wasn't until the 2000, early 2000s, when basically it became impossible for one household to carry the load. You all of a sudden it was like, okay, everybody's got to work. I mean, again, like I said, it was building a little bit in the you saw it a little bit in the 80s, and then it started to become more prevalent in the 90s, but then really started to really absolutely kicked in the last 25 years. So, but when I was a kid, that was not the case. When I was a kid, most of the people, again, middle class lifestyle, most of the people, one parent worked, the other parent was at home taking care of the kids. You didn't have all this daycare. There wasn't the need for it. So again, we have to, in my mind, if you're going to get the birth rate back head in the right direction, you've got to make things more affordable for people. We have to give more. There has to be a lot more incentives back to the middle class. I'll put it that way. All right, let's keep going. Let's look at the labor market here for a few minutes. So, a growing disconnect means millions of job postings never result in a hire. So this gets into what I have talked about in the past around the ghost postings. Nearly 1 in 3 job postings go nowhere. Education and health, 50%, government, 60%, information, 48%, and financial activities, 44%, are the worst hit sectors. Since 2021, the phantom gap between openings and hires has held steady at 28 to 38% each month. The phenomenon of ghost job postings has reached a point where it's earned its own label, the ghost job economy. That moniker comes from My Perfect Resume, which is in a recent report looked at the impact of millions of job postings that never result in an actual hire and why the disconnect is happening. So in my research, My Perfect Resume found that nearly 1 in 3 job postings go nowhere. That means 30% of job openings, which amount to more than 2.2 million roles, never result in a hire. Never. The report pulled data from the Bureau of Labor Statistics job openings and labor turnover survey to further analyze why job seekers have become increasingly frustrated with the lack of real opportunities and why many have lost trust in the labor market. According to the report, the change began to happen in 2021. Prior to that, job postings and hires moved in tandem for more than a decade after the Great Recession. From 2010 to 2019, job openings grew from 2 million to 7 million, with hires following a similar trend. During that time, the gap between the two rarely grew beyond 10%. As expected, the report notes that the pandemic cratered both postings and hires, but the two were able to rebound together. However, openings spiked above 11 million, while hires hovered around 6 million to 7 million across 2021 and 2022. During that time, as many as 38% of postings were unfilled. As the economy cooled from 2023 until now, the ghost job rate has remained at 28 to 32%, according to the findings. Now, ghosting goes both ways. The softening job market, especially compared with the red hot market of 22, has created a ghost effect for both employers and employees. So, you do have there is a thing of the ghosting of job candidates. Like that is a real thing. But these ghost jobs, like this is a problem. Like you see a lot today of people posting that they've put out hundreds of resumes, not like 5 or 10 or 20, hundreds. I mean like 400, 500, 600 resumes. And part of what you're seeing here is this these ghost postings, these jobs that aren't really meant, they're never meant to be filled, and there's millions of them out there. So like I said, you have 30% of all your job postings out there are just ghost postings. They're just BS jobs. They're never going to get filled. So you're just wasting your time applying for them. The problem is you don't know which ones they are. So it also inflates the picture of the labor market. So you might be sitting right there and you might be going, oh, there's currently 7.2 million job postings right now. Well, no, there's really not. There's probably only really maybe about 5 million actual jobs that are out there right now. Still not bad, but it inflates the picture of what's really going on there, which doesn't really help anything. And then moving on here. So U.S. workers increasingly turn to the gig economy as the job market loses steam. So gig economy is on the rise in many urban areas where job cuts are felt most keenly, Goldman Sachs said. So contraction in the country's labor market amid widespread layoffs among major employers is leading to an increase in the number of people joining the ranks of the gig economy, according to a November 17th report by Goldman Sachs. Between 5% and 15% of Americans are supplementing their income through gig work, which includes temporary contract and freelance work, as well as platform-based gig jobs such as driving for Lyft or delivering for Uber Eats, Instacart, or DoorDash. Some guy on YouTube named the banker next door, like according to the report. No, just kidding. Slip that last one in there, just seeing if anybody's still awake out there. Yeah, it's a side hustle, right? It's a side hustle, baby. So it's what we're all about. About 20% of current gig workers either lost a job, took a pay cut, or faced reduced hours over the past 2 years and turned to gig work, the analysis found. Almost half of all workers in the gig economy take a gig work to supplement their primary income, while 15% are gigging as their main source of income. The rise in gig employment comes amid a widespread cooling in the U.S. labor market and large-scale job cuts by companies such as Amazon and UPS in recent weeks. And let's look at a couple other things here. So, oh wait, did I skip that? I didn't. I thought there was a couple other things on there. So, all right. So we're getting the tariff news or whatever. So, all right, hold off on the tariff thing for a minute. I just want to run through. Some other bank news here. I want to run through just a series of quick bank articles here. So let's look at this for a second. There's another insurance crisis hitting businesses. It could cost millions. So, Hiscox survey found that 77% of small businesses are underinsured. Most small business owners misunderstand their insurance policy coverage. Cyber attacks have increased, with firms averaging 35 or more attacks yearly. Most small businesses are chronically underinsured, and those companies that are insured often don't have a complete grasp of their coverage. That's one of the top takeaways from a survey of 2,000 small businesses by specialist global insurer Hiscox, which found 77% of companies are underinsured, up more than 2 percentage points from 2023. The survey comes amid employers facing sticker shock for health insurance, as well as concerns over inflation that are leading businesses to find ways to cut cost. One way they're doing that is attempting to reduce insurance premiums, a move that could be costly if business owners don't understand the impact of policy changes. So yes, so this is just something that we really need to keep an eye on. Basically, a lot of businesses being underinsured. So something to absolutely keep an eye on. So okay. Citi CFO Mark Mason to step down in March. The bank tapped Gonzo Luchetti, its head of U.S. personal banking, to succeed Mason, who will become an executive vice chair and lead by the end of 2026 to pursue outside leadership opportunities. Now, why is this interesting, or why is this important? And I'm going to tell you right here. So, Citi CFO Mark Mason, arguably the highest profile Black executive at a U.S. based, globally systemic important financial institution, will step down from his role in early March, the bank announced on Thursday. At that point, Gonzalo Luchetti, now the bank's head of U.S. personal banking, will become the CFO. Mason, meanwhile, will transition to executive vice chair and senior executive advisor to Citi CEO Jane Fraser, but he intends to pursue leadership opportunities outside the bank by the end of 2026, according to the announcement. So, in other words, this is a big deal because this gentleman, Mark Mason, was in line to basically be, basically as a potential CEO. Looks like he wasn't going to make it there to the top, so he's decided to go look, in other areas. I'm sure this gentleman's going to have a lot of success with whatever he does, but it was an important thing because of who he was and where he was, just in the very large bank picture, if you will. So point that out. So Capital One joins FedNow. So the bank signed up for the Federal Reserve's real-time payment system this week, leaving just 2 of the 8 largest U.S. retail banks that have not. So Capital One joined the Federal Reserve's instant payment system FedNow this week, leaving Bank of America and Truist among the major U.S. financial institutions not participating in the real-time ecosystem. Capital One started its FedNow participation Tuesday, a spokesperson said for the bank by email. So, okay, so basically Bank of America and Truist, we'll see when they get on board the train. One of my favorite things here, open banking. Senators back open banking rule. So Democrats urge the Consumer Financial Protection Bureau to pursue an open banking rule that lets consumers freely shift personal financial data. Well, considering the fact that it was Joe Biden's CFP that pushed this thing out there in the first place, of course, the Democratic, senators are going to get behind this thing. Again, I don't need to say anything more on this. Okay. I've done a bunch of episodes on open banking. I just absolutely open banking is a horrible, horrible thing. And we believe me, as a consumer, you don't want this. You don't want this. It is not this whole tagline about, consumers are going to be able to freely shift their personal financial data. No, you are going to hand your data over to Google and Meta and Amazon and Plaid or Plaid, whatever it is, and every other big tech company out there that wants your personal data. They are going to be able to siphon it from the bank. This is open banking is a horrible thing, and you do not want this. You do not want this. Flat out, just absolutely not. No. And that's all I'm going to say about that for right this second. Okay, so White House nominates Vought aide to lead CFPB. So a Burrow spokesperson who declined to comment on the fate of the agency said Stuart Levenbach's nomination is technical and extends Russ Vought's tenure as acting director. So the White House on Tuesday nominated Stuart Levenbach to be director of the Consumer Financial Protection Bureau, a Bureau spokesperson confirmed Wednesday. It's a purely technical appointment intended to extend Russ Vought's tenure as acting director Further, the spokesperson said Levenbach is Associate Director of Natural Resources, Energy, Science, and Water at the Office of Management and Budget, which Vaught leads. Levenbach also serves as an aide to Vaught. According to the Federal Vacancies Reform Act, a person can serve in an active role atop an agency for 210 days if it's a role subject to presidential appointment and Senate confirmation, but that person's tenure can be extended if the president nominates another person for the position. So Vaught was named acting CFP director on February 7th. So, and then we go to this. CFPB is transferring its cases to DOJ. The Bureau's acting enforcement chief told staff in an all-hands meeting Thursday that all CFPB employees, as he understood it, would be furloughed at the end of the year, according to a report. So, the Consumer Financial Protection Bureau is transferring all of its active litigation to the Justice Department, according to separate statements Thursday from Senator Elizabeth Warren and the workers' union representing the agency. Furthermore, Mike Salemi, the CFPB's acting enforcement chief, said at an all-hands meeting on Thursday that, as he understood it, all Bureau employees will be furloughed at the end of the year. Government executive reported, citing people familiar with the matter. Salem hedged, saying he was not privy to all of the plans, but that the information came from an associate general counsel at the Office of Management and Budget, who also serves as a senior legal advisor at the CFPB. The timeline, if true, would dovetail with the projection CFPB acting director Russ Vought made in a podcast appearance last month, when he said the only employees left at the Bureau were our Republican appointees and a few career staff that are doing statutory responsibilities while we close down the agency. We want to put it out, and we will be successful. We will be successful probably within the next 2-3 months, Vaught said. So yes, looks like we are perhaps coming to the end of the CFPB, but we shall see. Florida Credit Union to buy Georgia Bank. The transaction set to close in the second or third quarter of 2026 will expand Community First total assets to $3.3 billion with a 31 local branch footprint. And again, this is what I talked about a few minutes ago when I was going through the banking news. You know, ICBA basically really saying that, hey, we need to have tax exemption on these credit unions that are over $1 billion in asset size. So again, this merger here will create a credit union with $3.3 billion in assets and 31 bank footprint. So obviously, that's not what your original credit union was supposed to be. So again, we're until this tax exemption is annihilated, you're going to continue to see credit unions buying banks, which to me is not a good thing. FDIC countersues Capital One over special assessment. So the bank still owes $99.4 million to the Deposit Insurance Fund after the 2023 failures of Signature and Silicon Valley Bank, the regulator said on Monday. So the FDIC accused Capital One of paying $99.4 million less than necessary to replenish the Deposit Insurance Fund following the 2023 failures of Silicon Valley Bank and Signature Bank, according to court documents filed Monday. The FDIC's lawsuit countered legal action taken in September against the regulator by the bank, which alleged the FDIC imposed an outsized and improperly calculated special assessment fee on Capital One. So we shall see what happens with this. Okay, Meta, those slippery suckers, they slipped out of another one. So Meta defeats FTC's antitrust case alleging social media monopoly. So the ruling denies the agency's attempt to force the Facebook parent to unwind its Instagram and WhatsApp acquisition. So just as the case with Google, where Google has escaped getting broken up, Meta escaped as well. Man, these judges just can't seem to find that monopoly when that monopoly slaps them across the face. So here's another great one. Cracker Barrel investors vote to keep on CEO, but send a message of discontent. Julie Fells-Messino and board member Gilbert Davila had been targeted by activist efforts. Yes, this woman should have been fired. She should have been fired immediately after her stupid brand change. That was an absolute colossal disaster. Okay, cost Cracker Barrel $700 million. So yes, should she have been fired? Absolutely, positively, should have been fired within 5 minutes of that stupid decision. But they voted to keep her around. They're going to keep her around to see what other dumb decisions she can make next. So there you have that. That's all I got to say about that one. Okay, a new prediction market startup is taking on Polymarkets and Kalshi. The clearing company applies for a CFTC license seeking to provide underlying plumbing to process bets. So, a team of prediction market veterans is launching a new platform that will underpin bets on future outcomes in politics, sports, culture, and other areas. The clearing company, a San Francisco based startup, says it differs from competitors because it will focus on providing the underlying plumbing to process bets instead of building its own website and app to reach individual users. Potentially, brokerages could plug into clearing's technology to offer access to prediction markets alongside stocks, cryptocurrencies, and other trades. So very interesting. So we will keep an eye on that one. The golden handcuffs apparently are off. Private equity employees leave for smaller firms. So employees are doing the math on a key form of pay and taking their chances elsewhere, picking up their ball and taking it home. The job of a private equity firm was once a ticket to lifelong riches. Now employees tired of waiting for payouts are leaving for jobs at smaller shops. Usually, the bigger the private equity firm, the bigger the payday. But with the industry struggling to profitably unload companies, many employees are heading for the exits, opting for jobs at smaller firms where they are betting they will be able to earn more. A key form of compensation is driving the moves, with middle-level employees at big prestigious firms leaving potential paydays worth millions of dollars on the table. They are worried about when and if their carried interest or carry pay tied to the performance of their deals will materialize. The golden handcuffs aren't so golden anymore, says Stephanie Gavita, who previously oversaw business services investing at private equity firm Warburg Pincus. Top talent is doing the math and realizing that a piece of a smaller fund that actually performs beats a theoretical windfall that may never materialize. So very interesting. Things going on in the private equity world. Maybe some private credit turmoil in there too. Maybe, just maybe. Yeah, I'm sick. I'm thinking some people are looking and going, yeah, I've got this portfolio of you know what, and it stinks, man, and I better get out of here before this whole thing blows up. I think they're seeing some of that there too. All right, I'm going to come back to this in a minute. I wanted to end with this, but I want to jump back to, let's just jump back to the tariff thing for just a second. All right, I'm going to blow through some of this tariff stuff real. All right, we did that. So where am I at here? All right, wait. We're going to blow through some of this tariff stuff real quick here. So tariffs will reduce U.S. trade deficit by $1 trillion less than previously estimated. Congressional Budget Office, roughly 2/3 of the downward revisions result from adjustments to reflect the new data. So the CBO saying that basically tariffs will not reduce the U.S. deficit by as much as previously estimated, but still reduce it by $1 trillion. Trump says U.S. companies signed $270 billion in business deals with Saudi Arabia. Companies unveiled new investment and sales agreement in the areas of AI, energy, finance, and aerospace. Love to see it. Good stuff. Imports dropped sharply in August, narrowing the U.S. trade deficit. So August's smaller trade deficit will be a tailwind for third quarter real GDP, Comerica Bank's chief economist said. So basically, President Donald Trump's tariffs helped narrow the U.S. trade deficit in August as imports contracted by more than 5%. New government data showed the trade gap plummeted by nearly 24% to $59.6 billion, down from $78.2 billion, according to a report released by the Commerce Department's Bureau of Economic Analysis on November 19th. This came in below economists' expectations of a $61 billion trade imbalance. So again, kind of heading in the right direction. And let's see here. U.S. aims for Thanksgiving deadline for China rare earths deal. So the agreement is that the magnets will flow freely as they did before April 4th, Bessent said. So the U.S. Treasury Secretary Scott Bessent said on November 16th that the government is expecting to finalize a Chinese rare earths deal by Thanksgiving. His remarks were made after news that Beijing was looking into a verified end-user system that would prohibit companies linked to U.S. defense from acquiring rare earths. I'm going to step out, wait for it. I'm going to step out on a limb here, and I'm going to say this ain't going to happen. So, yeah, China, they don't keep their word on anything, guys. If you haven't figured that one out by now, hopefully you will soon. Yeah, so I don't see this happening by Thanksgiving. Energy Department dismantles major Biden-era offices, shifts focus to nuclear fossil fuels. The department has canceled billions of dollars in federal funding for Biden-era energy projects over the past month. So again, in a major internal reorganization, the U.S. Department of Energy is dismantling several offices that played key roles in the Biden era push to transition the nation away from fossil fuels, according to a revised organizational chart. The chart shows that the Office of Energy Efficiency and Renewable Energy and the Office of Clean Energy Demonstrations are gone. And offices focusing on nuclear power, hydrocarbons, and fossil fuel deployments are elevated to replace them. Fantastic. Love it. Love it. Love it. Love it. Love to see it, man. Ah, beautiful day. Beautiful day. Fantastic. Love to see it. Good stuff there. U.S. economy created 119,000 new jobs in September, topping market estimates. So the latest non-farm payrolls report is the first monthly jobs data since August. So the Bureau of Labor Statistics delayed September employment report showed that the United States added more jobs than expected, suggesting that the labor market could be rebounding. I don't know about that, but we'll see. The economy created 119,000 new jobs, up from the downwardly revised decline of 4,000 jobs in August, according to the non-farm payroll report released on November 20th. The unemployment rate ticked up to 4.4%, the highest since October of 2021, from 4.3%. So again, I would remind people that a lot of the layoffs have actually been on the government side of things. So just keep that in mind. A lot of government layoffs, as you know, the Trump administration has been working to shrink the size of government, even though it may not be substantial. It's still a shrinkage. So you got to keep that in mind when you're looking at some of these numbers. But do I think this means that we're going to have some kind of major rebound on the labor market? No, I don't. I'm not ready to signal that yet. And the fact that we're not going to get a report in October, and then we're going to have to wait for the November report and the December report to begin to try to get an idea of what the trend looks like again. Yeah, we'll see. We'll see on that. U.S. private sector cut 2,500 jobs per week heading into November, according to ADP. So the Department of Labor has resumed its flow of employment data ahead of key September jobs reports. So job growth in the private sector remains sluggish heading into November. New data from the private payroll processor ADP has revealed private employers trimmed an average of 2,500 jobs per week in the 4 weeks ending November 1st, according to the ADP report published on November 18th. This follows last week's report, which found that the private businesses were shedding payroll by an average of 11,000 per week over the previous 4-week period. So again, that weakness in the labor market. And that's why I'm not willing to say yet that we're seeing this big rebound, because we are seeing the private sector cutting, albeit not a huge amount of jobs, but still, I mean, that's about 10,000 jobs a month. Yeah, that's not great. I certainly would like to see it adding 10,000 jobs a month as opposed to reducing. U.S. business activity accelerates, with new orders notching biggest gains so far this year. So new orders surged to the fastest pace of 2025 as services drive U.S. growth, signaling solid late year economic expansion. So that's good. And then is the shrinking trade deficit about to give GDP a lift? So the U.S. trade deficit shrank by 24% in August, according to a delayed report on Tuesday. The improvement in the trade deficit is expected to boost economic growth, according to forecasts. So the U.S. trade deficit fell sharply in August, as newly released information showed. The trade deficit fell by nearly 24%. Let's see here. The Trump administration introduced a series of new tariffs that month, blah, 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 blah. But the August trade data, which had been delayed, follows yet. Trade data could indicate strong GDP. So an improvement in the trade deficit could lead to a better result in the third quarter gross domestic product. In fact, the Atlanta Federal Reserve has already updated its GDP Now projection tool to reflect the change in exports, moving its third quarter GDP forecast up to a tick of 4.2%. Fantastic. Absolutely fantastic. So again, you're seeing the trade imbalance come down. You're seeing inflation not, not moving down yet, but certainly not going up. And you're seeing GDP really picking up, which is good, which is great. Again, those are all good things, all really good things. And I think we came back to, okay, let's go back to this last article I have here for a second. So I just want to talk about this for a minute here. So I saw this. Very interesting here. So an MIT student awed top economists with his AI study, then it all fell apart. So Aidan Toner Rogers shot to academic fame in a field hungry for new insights and revelatory research, but a computer scientist thought something seemed off. Now, I'm not going to go through the whole article, but basically, this kid made it all up. He fabricated this whole thing. And this gets back to this kind of psychological thing that we see from time to time. It gets back to kind of the issue that I talked about with like Charlie Javis with Elizabeth Holmes from Theranos a couple years back. Sometimes you get these situations where something is hot or a person is hot, and people come out with stuff and they so want it to be true that they just so quickly elevate it and push it out there, only to find out that it was all BS and it was all nonsense. And again, this is not new. This has happened before, and he happened to jump in on obviously the AI bandwagon when it was super hot. And he gets, this kid gets elevated real quick, and he gets elevated. People were so fast to want to just believe everything that this kid put out there that, again, he gets lifted up, and then the bubble bursts from underneath him. And I just point this out not to ridicule or lambaste this kid or anything like that. I just pointed out to just say that, this should be a reminder for all of us that sometimes you just got to be careful in life. This is why patience is a good thing. Patience is a virtue. This is why, you have to learn to be patient. It is one of the hardest things that I've had to try to learn in life, and I'm still learning it. I'm not all that great. And again, this is just something that we all have to be cognizant of. We all have bias. We all have flaws, and we have to constantly be mindful of them. We have to constantly work on them time and time again. Try, I think, very hard not to just jump into things just because they're hot. Sometimes you got to let things marinate a little bit. I think, cooking is a great thing. Whether you're a cooker or you're a baker, sometimes you gotta let things cook, man. You gotta let them marinate. You gotta let them bake. You gotta be patient. And again, it's an old saying, experience and knowledge are what create wisdom at the end of the day. And wisdom, a lot of times you have to go through a lot of painful experiences, and you have to make a lot of sacrifice to earn that knowledge by studying and reading, developing yourself. But when experience and knowledge come together, that's when you get wisdom. But that experience and that knowledge has got to bake. It's got to marinate. It takes time. So again, I just point this out to just say, be careful. Be careful out there. Like, don't jump on the thing just because it's the hot thing at the moment, because it may not be forever. So, all right. Okay, I actually have a comment here just a minute ago. James, let's see here. James Dick, 1128 said, with all the uncertainty of today, would you recommend against total stock index funds for long-term retirement savings, or am I completely overreacting? Well, James, I will tell you one thing. This is the Strategy Room, and we do talk all things banking and business here in the Strategy Room. However, I am not a financial advisor. I do not give out financial advice per se. So I would refer you to a financial advisor to talk about such topics. It is a very good question, but not something I would be prepared to answer for you. So I would defer on that one. So hopefully, but again, if you want to talk some of the other topics and things that are out there, if you got anything else that's on your mind, please chat it up here in the chat. Be happy to go through that with you. So, but okay, we are going to go into a wrap up mode here. I'm gonna go just something. I gotta get my hold on, I gotta get my banners ready here. So okay, let's get the first one here. So okay, if you are listening to the podcast on Apple Podcast or Spotify, please leave me reviews, as that really helps the channel. Need your Apple Podcast and Spotify reviews. Please visit thebankernextdoor.com. If you have not visited the website yet, please check it out. I would love feedback. If anybody's got feedback on the website, has some recommendations, or maybe thinks of some ways I could improve it or make it better, I am always all ears. Always love feedback. Make sure to subscribe on YouTube if you want the latest updates via posts. So if you want to know what episodes are coming out for the week, if you want to know what topics I'll be covering in the strategy room on Saturday night. If there's a move in the strategy, like sometimes I have to do strategy room on Friday nights. If I'm going to move it, I put all those out there in YouTube posts. So if you want to get the latest news and posts just on what's happening with the channel, subscribe on YouTube. Send comments. You could send comments, questions, or topic recommendations to info@thebankernextdoor.com. That's how you get a hold of me. Info@thebankernextdoor.com. Make sure to follow me. I'm on Getter, X, and True Social. I probably am the most active on X if you want to follow me over there. And just remember, BND is on YouTube, Rumble, and all major podcast platforms. New episodes come out every week, Monday through Friday, premiering at noon. Now, the episodes are usually pretty short. They're usually only about 10 to 20 minutes in length. I make them shorter specifically. I like to focus on specific topics in those episodes, and I try to make them more edible. You could listen to them real quick on their way to work, way home, whatever. But that's the point in the episodes I put out during the week. And then BND Strategy Room live every Saturday night here on YouTube. Hoping to expand the live stream to some other platforms here in the very near future. I'll keep you updated on that. That will maybe we'll get something in December, but definitely by early next year. Okay, and then let's see here. So that is my stuff here. Now let's go to our story of the week, and let's go to our quote of the week. So we'll start off here with our story of the week, which is economic sanctions. So economic sanctions are penalties levied against a country, its officials, or private citizens, either as a punishment or in an effort to provide disincentives for the targeted policies and actions. Economic sanctions can range from travel bans and export restrictions to trade embargoes and assets seizures. By definition, such sanctions apply to parties not readily subject to law enforcement by the sanctioning jurisdiction. Economic sanctions provide a policy tool short of military force for punishment or forestalling objectionable actions. They're widely applicable beyond the sanctioning country's borders and can be costly to their targets amid increased global trade and economic interdependence. And that's economic sanctions. A great example of that currently would be the economic sanctions we have placed on Russia. So if you wanted a good example, that would be a perfect one. So economic sanctions, there are story of the week. So, okay, now let's go to our quote of the week. So, okay, I will tell everybody I spent this week basically watching the documentary from Ken Burns on the American Revolution. And I was somewhat disappointed in the documentary just because I felt that Ken Burns put too much politics into the documentary. I felt at times it was really too heavy on the modern day political ideology, I'll say it that way, as opposed to really looking at in a modern secular lens, which I just my personal take is I don't think you should do that. I think you should look on history and just tell the story as it was at that time period. But anyway, I digress. So with that being said, so with the fact that there was that focus on all the American Revolution documentary this week, I thought it would be apropos to find a quote from one of the founding fathers, and I found a great one from former President John Adams. So, we have no government armed with power capable of contending with human passions unbridled by morality and religion. Our Constitution was made only for a moral and religious people. It is wholly inadequate to the government of any other. So, and that was from John Adams. So that is our quote of the week. So, with that being said, I thank everybody for joining me here this week. I hope everyone has a great week out there. Have a great weekend. I hope everybody has a happy Thanksgiving. There will be episodes coming out this week. There will not be an episode on Thanksgiving. I'm going to give everybody a rest for Thanksgiving, but there will be episodes the other 4 days this week: Monday, Tuesday, Wednesday, and Friday. So keep an eye out for that. Otherwise, I will see you guys back here next week. Same bad time, same bad channel here in the strategy room with the banker next door. Have a great weekend out there. See everybody again real soon. Thanks.